like you to remain on the board, but certainly this would be your opportunity to say, I'm done serving, but if you would like to serve
Yeah,
again?
no, I'm still planning on it.
Okay.
I have it posted.
Oh, you have already, oh,
Yeah,
wonderful.
we posted for 2 weeks, and I believe the 26th.
I believe so.
Yeah, I believe the 26th it will come down. As of now, nobody has signed up, but obviously they still have a little over a week. So I still plan on being on the board, and if we'll see what happens.
Okay.
So, yep.
Thank you. Thank you for being ahead of that and getting it done. I
Yeah, no
appreciate it.
problem.
So the next topic, the discussion of commingling fire and police trust fund assets. And Paul, I'm really glad you're here because I'm sure you know at least a little bit more than I do. First and foremost, this is something Danny brought up last quarter. He was talking about an education conference he attended and mentioned that he had heard of plans doing this and wanted to look more into it. This wouldn't be combining pension plans. It would be just commingling the trust fund assets, which, would be hopefully maybe lead to more investment opportunities with higher investment minimums or things like that. So I'm not exactly sure what the benefits are or what it would take to do it, but I did find in my research some examples of defined benefit plans that were combined. So I'm thinking it would just be, an ordinance change, probably more complicated than that. But of course, we would need the police board to also sign on to this. So I guess maybe hear from you guys what your thoughts are on this. And Paul, if you have any experience with plans doing this, that would be wonderful, because it seems like it would be a legal process.
Yeah, I guess I'll start. I think we just need to identify what the benefits are. If it's truly beneficial, then I think we should proceed in finding out more information. I guess it's from an investment standpoint that it's more beneficial, but our investment folks are here, so maybe they can help us with that thought as well. Paul, do you have anything you can add for us? I don't think you can hear us again.
That's directed to me.
Yeah.
Yes.
I think it's a good one.
We're just trying to discuss.
Great. So, sorry, I'm still having a little trouble hearing, but I can kind of make it out. So, you would like me to address the idea of combining the police and fire pension trust fund assets? Is that what I'm hearing?
Yes, and we're trying to identify exactly what the benefits would be.
Or cons.
Or cons.
Well,
Or
I
cons.
guess
oh, yeah.
benefits could be that there'd be greater assets that then are, theoretically, and I would want the investment manager to kind of talk about this too. But I guess theoretically, with a greater pool of assets, you might have, I don't know, exposure to less.
Okay.
I really would have to look at the investment manager, legally speaking. You can certainly combine police and fire pension plans, chapter 175, which regulate, of the Florida statutes, regulates fire pensions, and chapter 185, regulating police pensions, are virtually word for word in many ways. They're very similar and not identical. And then they allow the plans to be combined. And you have to have a combined board of trustees. It would require bargaining with the union. Agreement reached and then ratified by the memberships and the legislative body of public employer, and then ultimately, what that agreement would yield an ordinance change. And I heard mentioned earlier about ordinance change. So it is done. Downsides, I guess, could be greater, more numbers means more administration of the fund, and it would probably change the constitution of the board. Giving therefore, in a way, you could kind of, some might argue, and I don't know if this is really actually true or accurate, but might have arguments that each side loses a little bit of control because they weren't controlling the whole thing, they involved controlling it with other people. So, those are some initial thoughts, and I'm happy to try to answer any questions about this or that.
Okay. Jack, I know we're hitting you with this cold, but could you share some, Jack is here for Kerry again this quarter.
So, make sure you can all hear me. So we've got a few things. So from an investment standpoint, there's really not going to be a lot of gains from the additional assets because you're really going from 25 to 50 million. So there isn't any new opportunities that are going to open up to you. There isn't a lot of savings because of the additional assets in the portfolio. If you were going from 25 to a billion, maybe so, but from in that scale, not a lot of investment changes. I'm familiar with the plan I'm the most familiar with that is set up this way is Maitland Police and Fire. Now it's an old plan. They didn't combine. To my knowledge, they didn't combine. Their benefits are completely separate. They just pool their assets from an investment perspective. Now their board is actually 9 members. It's kind of unwieldy. I would say that's a lot of folks to have on a board trying to come up with consensus on things. But it's manageable, and I think they have a good relationship between the police and fire. And they actually have 3 city, 2 city appointees, and a city in like the city finance director.
Very
on
good.
their board.
Did you used to be their consultant?
Yeah.
Okay, I'm their administrator now,
Yep.
so it's true. There are 9 of them: police chief, fire chief, finance director, and then 2 firefighters, 2 police officers, and 2 city council appointed. And police and fire, they do have different provisions, but they don't always agree on investments. So, and I've witnessed that firsthand. It can be a little tense at times, but for the most part, they get along, yes, and they get different state monies distributions and everything. But yeah, I didn't even think about Maitland.
Yeah.
My own
So
plan.
actuarially, you do one. I think you do 1 valuation instead of 2. I'm not positive about that. You probably know better than me if they do 2 separate valuations. For
Maitland
that.
does 1. I don't know if that's a rule for all plans that are combined like this, but just 1 valuation.
From a custodial standpoint, I'd have to look at your custodial contract. They're generally done a couple different ways. You can have an all-inclusive asset-based fee. You can have some type of an asset-based fee plus additional costs for additional accounts. Now, there's potentially some savings there. I don't know that's going to be a big number. I mean, my guess is you're probably paying around $7,000 for custodial services now. It's probably could save a couple $1,000s there. So I don't know that there's a huge financial benefit to doing it. We could look into that a little bit more, but there's certainly no real drawback to doing it other than the size of the administration.
Yep.
I mean, you're splitting costs for all
Sounds
of
like
the
to me there's
services.
not a huge benefit.
I don't think so either.
No.
And I'm also,
And, I mean, not sound, whatever, you lose power. Not that we're all power hungry here, but it's
No,
just,
I agree.
if we're fighting for stuff on the fire side and the police want something on the police side, you could have a clash where right here, we fight for what we want here. I don't know.
Yeah,
If there's a huge financial gain, I'd say, yeah, let's look more into it, but it doesn't seem like there is.
it doesn't seem like it at all. It seems,
So,
it was worth talking about.
yeah, definitely worth discussing.
Are you happy with that?
Yeah, just as it says,
Okay. Any
kind
other-
of information
Yeah.
gathering, that was all.
Yeah, absolutely. Everything's worth looking into. Any other comments? Anybody? Okay, then we'll consider that tabled. Reports. Patrick.
And as Patrick is making his way to the stage, those of you that are using the tablets, if you don't see in the top right corner of your screen a little, looks like an index card, tap the screen so some icons appear. And in the top right, there should be 4 icons, and the one that's farthest to the left, it looks like an index card. Oh, I'm sorry, no, I'm so sorry. So, tap the screen, hit the back arrow that's in your top left corner. Apologies. That should take you to the home screen. And the experience study is right under the Punta Gorda fire packet. Should say fire in big letters, dash experience study. And this way, all the pages that Patrick references matches what's in front of you.
I have 3 paper copies. Does anybody want those?
I
can give them
I
to the
printed my
audience.
own, so. Yeah, I printed my own, so.
I'll take one.
Patrick, you have one here.
Thanks.
So when we do the evaluation report every year, that's the biggest thing that we do, and we project out everybody's future benefits, and we project out the assets, and we determine an appropriate funding requirement for the city for the next year. All of that is based on assumptions. And so every 5 years, you're supposed to look at all of your actual experience, you know, for turnover, retirements, investment return, and say, okay, what if we want to change those assumptions? Because you want to be using the most appropriate assumptions that you can. Otherwise, the city's costs can go up or down each year because we're not using the right assumptions. So that's the purpose of this study. And if you go to page 4, this one's a little bit complicated, but basically when somebody's hired, we project their benefit and we say, okay, we need $1 million by the time they retire, let's say, just for a round example. And we have 20 years to do it, we could put in $50,000 a year. So that's without any interest or anything. And that's the normal cost. That's just the cost. If we put that in each year, then we'll have enough money to pay their retirement benefits. Well, the normal cost, the way we are doing it now, is we start from the first valuation date. So if they're hired in April, we would start that normal cost October 1st, you know, because that's when we do the valuation. So we would spread it out like over 20 years instead of 20 and a half years if we had started it in April. And so the proposed method just spreads it out over 20 and a half years instead of 20 years. So you get a little bit smaller normal cost. But then your accrued liability is a little bit higher because now they've accrued some liability from April to September. So it's just another way to do it. And if you look at the page 5, that would actually reduce the city's funding requirements slightly, but they would show a larger unfunded actuarial accrued liability. So most all of my boards have made this change. It doesn't hurt anything, and there's a slight reduction in the city's funding requirements. Does anybody have any questions about that part?
Well, why don't we just pause here for a second, just we're going to throw out a suggestion. We'll vote on this as one complete package when it's over, but I think we should just kind of do consensus at each one of these things so we don't have to come back and visit it. If anybody's got a problem with it or a concern, then let's talk about it now, or if not, we'll assume it's good. Does that sound like a plan? Okay, then we have consensus.
All right. So the second on page 6 and 7 and 8, or 6 and 7, is the investment return, but I'd rather skip that till the end.
Okay?
And then mortality is on page 9, 10, and 11. And so this is another one we don't really need to talk about because several years ago the state passed a law and they said that all local plans have to use the same mortality assumption as FRS. And so FRS changed their assumption in July. So that means we have to make this change when we do the 10/1/2025 valuation report. The one I'll be presenting to you next, in November or December. And so, but this is showing you the old mortality rates and the new mortality rates. The old ones that we were using is on page 11, and the new ones are on page 10. And you know, these are kind of good pages because everybody always says to me, you know, how long am I supposed to live? And so if you look at page 10, you know, if you're a 45-year-old or 50-year-old retiree, it says you're going to live about 34 years, so about 84. So that's kind of, you know, the...
Is this going off of normal people or firemen? Because we don't we don't live as long.
Well, this is going off of a huge public employee study
Right.
that the SOA did a few years ago.
So it's not off of firemen.
It's not specifically off of firemen.
Gotcha.
And so if you look, the problem with this is that if you go to page, if you go to the bottom of page 11, especially for male retirees, if you compare those two tables, male retirees are supposed to live about 2 years longer under the new assumption. And so because of that, if you look at the bottom of page 11, you know, that's going to increase the funding requirements by about $83,000 a year. And that's, there's nothing we can do about that, but I just wanted you guys to see that in the study.
So if we're understanding this correctly, you're presenting this as information, we have no choice, and so,
Correct.
got it.
So page 12 is where we look at the retirement rates. You know, you don't have a lot of retirements, but in the last 10 years, from October 1, 2014 to 2024, you had 4 retirements. 3 were drop and 1 was normal. And you can see that they pretty much all went at their first eligibility for normal retirement, but one of them went 2 years after their first eligibility for normal retirement. And if you look in the middle of the page, that's our assumption right now, is that once you get to normal retirement, we say there's an 85% chance you're going to retire right then. And then the next 2 years, 50% each year, and then 100% at 3 years after normal. And really, if you look at it, that's pretty much the experience that you've had. So we're not proposing that we make any changes to the retirement rate assumption. Is everybody good with that?
Okay.
And then page 13 is people that separate before retirement. So these are the people that work 5 years and then you get terminated, or do they go find another job, or what have you.
This is so basically non-vested. Non-vested.
Well,
basically.
and vested
Okay.
before retirement, so in that
Okay.
10 to 20 year
Yeah.
range.
Okay.
But but in that vein that you just said, so you can see the table there, you know, you've had 6 people leave before retirement in the last 10 years, and all 6 of them were before 10 years of service.
Right.
So to your point, people, once they're vested, they've been staying until retirement. And the 1 to 9 years of service, you've had basically 4.4% turnover, and our current assumption was 3.6, so we're proposing to bump it up to 4%. Kind of like right in between our old assumption and your actual experience. And so, you know, bumping slightly up that turnover assumption, that reduces the funding requirements, because if people leave early, they just get their own contributions.
Right.
So that reduces the cost by $8,000 a year. Is everybody comfortable with the turnover?
Makes sense.
Disability is the next page, 14. And you know, we have a low assumption. We don't feel that a lot of people are going to become disabled. And in the last 10 years, you've only had 1 disability during that time. So our proposal is to leave our assumption alone for disability.
Makes sense, everybody?
We skipped salary increases, didn't we? I didn't mean to do that. Let's go back to, that's on page 8. So, when we're projecting people's benefits, their benefit is based upon their final average salary. So it's a big deal if you project they're going to get 10% increases each year or 2% increases each year. You're going to get a much different projected retirement benefit. And so right now, we only just have a flat 6% assumption. In most of my plans, we use a service-based assumption because most people get bigger increases at the beginning and then they level off when they get later in their career. And so, and you can see that that's happened with you. If you look at the actual increase column, it's the third one from the right. So it basically said that in the first year, the average has been 22%. But that's a little bit deceiving because what happens is when someone's a new hire, we ask the city, okay, what's their rate of pay? And they might tell us, $30,000 a year or something. But then when we look at their salary the next year, there's like overtime and stuff like that. So it ends up being higher, partly just because of the way we get the pay when somebody's hired. But then years 1 through 9, the average has been 8.5%, and our assumption was 6%. So our proposal is to go to 7.25% for those years. And then after 10 years, the average has been 6.58, a little bit above our 6% assumption. So we're proposing to go to 6.25%. So we're just making slight adjustments up because the average has been almost 8% over the last 10 years, and our assumption was 6%. But maybe the last 10 years were abnormal, so we don't want to say, well, let's assume 8%. So we're going partway in between and averaging about 6.8% will be our new assumption. But, making that assumption bigger, those projected benefits at retirement are bigger.
Right.
So we're going to have to put in more contributions right now. So that's that page there. So now we can go to the very end. If everybody's comfortable with salary increases.
Everybody good with that? It makes perfect sense to me.
Well,
but-
I get what it's saying with average. If you look like our contract, you're basically 6% a year. So,
Well,
if you
and
just
the
went off
thing,
that,
the
but
thing
then-
about that is,
yeah, I
is
get it,
that-
because then we have people, like right now, we just have promotions.
Exactly.
So then it's not going to be 6 because they're going to get 5 when they get promoted, 3 when they get off. So that's a total of 8 right there.
Exactly,
So if you're going,
exactly.
and they already got their other 3.
So this
So
isn't looking at
They
the
can help level that out.
overall.
Right.
This is looking at each individual. So
Yeah.
like you said, if the average is going to be 6, and then each time you get a
That's
promotion.
with
you-
absolutely nothing happening, which obviously stuff happens every year. So I get what he's saying.
Yeah, and the most significant is the first 10 years, and I think you've covered that well, so
Yeah.
I think this makes a lot of sense.
Quick question, Brandon. So the 6% is a hard floor across the board for everybody. then?
You get 3% for breathing,
Yeah,
and then you get 3% educational, which you're going to do it.
right.
So yeah, it's hard. You're getting 6% a year.
So without a doubt, then their previous one is too low because
Wait,
6% says if nothing happens, this is what
Exactly.
it's going to be. But things are inevitably going to happen. So, and to your point, that maybe the last 10 years is aberrantly high, but is 6.5 enough then? I mean, if anything positive happens to any of our employees, they get bigger than 6% increase. I don't know.
Yeah.
I mean, I'm sure there's a lot of thought that's
Well-
gone in behind this, but
Well, the
Would
thing
that
is
average
that,
out?
he mentioned that right now they have basically a 6% floor. And inflation, as we know, has been maybe 3.5. So ideally, in a normal world, your floor would be 3.5%. So that's why I think it has been a little bit abnormal, the last several years. And so, right now their minimum is 6, but in 5 years that might not be the case anymore. So that's why I think not going too high, but going up a little makes sense to me.
Fair enough.
So then the last page is page 15, but you guys have a 7.35% investment return assumption. And Jack is here, and I feel like that's a reasonable assumption for the long term. If we get 10% out of our equities and 5 or 6% out of our fixed income investments, then we're going to beat that over the long term. There's lots of ups and downs. We've had lots of volatility lately, but we're looking at it long term. Now, FRS is at 6.7%. The average of our plans last year was 7.05. So, I would be fine if you guys wanted to lower that 7.35 a little bit, but I'm comfortable if you left it alone at 7.35. But this page shows you at the top, if we go to 7%, that would increase the cost by about $178,000 a year. So if you wanted to go to 7.25 instead, that would be more like $50,000. You don't have to do exactly what's on this page. But if the problem is that all these other changes we're making, mortality, salary increases, all those are increasing the costs. So if you look at line 7, that would be, okay, let's do all of the changes Patrick recommended and leave our investment return assumption at 7.35. The city's costs are going to go up about $150,000 a year. So really, this is the time where you guys can discuss and ask me questions. And any changes we make, we'll make when I do the 10/1/2025 valuation. And that actually doesn't affect the city's funding requirements for another year. So, if you guys vote to make changes, it's not going to affect the city funding until 10/1/2026, just so you know.
And that's probably good because with the assumption that the total assessed property values is going to go down this year, that they're going to have a whole lot less money to work with, so that's kind of good. We have a year's buffer for them. Comments? What are your thoughts on the assumptions?
I think when we lowered the assumption rate in October, I believe we did already, we talked about doing it, reviewing it every October.
Yeah, and we do.
Slowly,
Yeah.
slowly decreasing it, to get it into that 7.6 range.
Well, then what you could do is you guys, if you wanted today, you could approve making all the changes and go to 7.3, and then just tell me you want to go down 5 basis points a year until you get to 7%.
I believe
And
that's
that
what
way-
we agreed on last time.
Didn't we already
We agreed on
do
that
that?
last time. Yeah.
I think we did.
Was it 10 basis points or 5 basis points?
I thought it was 10.
I thought so too.
I'm pretty sure it's 10. Yeah.
Well, then you could do that. Approve everything with 7.25, and we'll keep going down to 10 basis points each year.
And we were stopping at
Pretty
7.
sure.
For how many years though?
Right.
Yeah.
For how many years?
Until we hit the,
Want to get to the average, the
Yeah.
7% average.
7 years.
yeah.
Which was 7, so yeah.
Yeah, well, what we'll do is we're going to be at 7.25 next year, and then we'll be at 7.15 the year after that, and then we'll be at 7.05 the year after that. And then I'll come back to you because the average this year was 7.05.
Okay.
Okay.
What we need a motion? We need a motion just on that or on the entire?
No, what you could do is you could make one
done it
motion and say we're going to approve all of the recommended changes and go to 7.25% assumption. That could be your motion.
I'll
do that?
I'll make a motion to accept all the changes and go to 7.25.
Second.
Anything on the question?
Real quick, on the change of the assumption on the rate of return, was that supposed to go into effect each October, or is it okay, are we okay with making that change in assumption now in June?
Well, no, it'll go into
October.
effect October.
It'll go into
Yeah,
effect in
so-
October. Okay, so either way, October is the start date. Okay, thanks.
It's supposed to be every fiscal year. we're
Yeah,
supposed to drop.
which makes sense. Just want to
Yeah.
make sure we weren't getting off topic on that.
So just, I would like to
catch, good catch.
ask a question. All those in favor signify by saying aye.
Aye.
Opposed? Motion carried unanimously. Hey, just one quick question. So it's 7.25. What quick guess of what the city's increase would be? 60, 70,000, something like that? 80,000?
Yeah, maybe 75 to 80.
Okay, so it'll be 2.25 or so increase for them when this goes into effect in '26.
Correct.
Okay.
And you'll see that in the valuation report, because whenever I do the report, I show you with the old assumptions
Yep.
and the new assumptions. So you'll see that in December.
That's a considerable increase to the city's budget, so I wish Chris lost her name. Thank you. If she was here, I would like to have let her hear this first.
Then to your question you had earlier about the drop extension.
Yep.
We did, we have one primary person that does the coding for the drop updates, and they resigned and we hired a new person, and she's working out really well, but that happened in between, and so
I got you.
I'll get with her tomorrow,
Okay.
and we'll get that expedited.
Yeah, no problem. And he was, honestly, he was concerned his money didn't get lost in limbo. So
No, I'll make sure of that. It's
Yeah.
there, and
I don't think it's showing, it's not showing on his
On the portal.
on the statement, correct?
Oh, are you doing? Hi, Dylan. Nice to meet you. So, and I guess I can turn to you and ask, can you see the deductions on your paychecks? Like, it's coming out. Okay, so does it have like a year-to-date total or anything like that? So for now, you can kind of keep track of the total contributions?
I'm not sure about the year-to-date.
Okay. But we'll get it done either way, so I appreciate your patience, continued patience. And do you happen to know where his calc is for the refinance? Because he put down some money from FRS, and then,
yeah, I'll check it
Okay.
after the meeting. We can talk.
Sorry, with the assumption rate in October going down, would that affect my buyback? Would that affect that also?
It depends on the ordinance language. I hope not. Usually we say it's the interest rate when you enter, or when you decide to do the payments, because I don't like changing it every year if things change. But if it does change, that would only help you slightly.
Right.
So we'll check it out.
So it wouldn't be a complete almost a complete refi if assumption rate goes down, then his rate of interest that he was paying would go down.
Exactly. Maybe. We have to look at the ordinance.
Okay.
Sometimes the ordinance says it's at the time you make your purchase,
Right, yeah, you're
And
kind of, you're
sometimes
locked
it
in
would say
or,
that it changes, so we'll have to check.
gotcha, I appreciate it, thank you.
Recalculate every October, basically.
No, it would, yeah, if
with the glide path?
yeah, if it drops 10 every October, then yeah.
Any other questions for Patrick?
No, thank you, Patrick.
No
Thanks, Patrick.
problem.
Thank you very much.
Appreciate your business.
Yeah, I think
Thank you.
it was a good thing doing this. Next up is Mariners, and Jack is here representing Kerry again.
Good morning again, all.
Good morning.
Good morning.
Okay.
If anyone's using the tablet, if you have any issues getting back to the packet, let me know. Just find that back arrow, take you back to the home screen, and then just go back to the main packet. And the Mariner report begins on page 16 of 119, for those of you using the tablet.
Yeah, and I don't know if you can see, if you have page numbers on the tablet, you can see the page numbers on the PDF, right? So if I refer to a page number, okay. I put hard copies up there for you guys, if you want to use them, but if you're using the tablet, then I'll try to be sensitive to that.
It's a 16-page difference, so right now, so your report, I guess it starts, so page 1 of your report is page 17.
Okay, all right. You'll have to keep us on track from that, so.
I got you.
Okay, so you have two reports. You have the quarterly report, and then you have the monthly flash, which goes through the end of May. Obviously, quarterly report, page 2 on the hard copy, page 18. Okay, page 18 on the PDF, dealing with the economy and the markets and kind of everything that's going on. I don't know how much time to really spend on this. It all has changed pretty substantially since the end of March. And I think that's probably going to continue. Certainly a lot of things going on in the world that cause the markets and the economy, create a lot of uncertainty for both the markets and the economy. This quarter that we're dealing with was not the best quarter, obviously. Equity markets were down pretty substantially. Fixed income markets were the beneficiary of that, as everybody had this what's called a flight to quality, when you kind of take money out of risky assets and you put them into things that you think are less risky. And so you see that with value stocks doing better. You see that with bonds doing better. Some of the big growth tech names did poorly. International stocks did well during this period of time, both on a local currency basis and when you convert those back to US dollars, because the dollar weakened relative to a lot of foreign currencies during this period of time. So a little bit of a mess from an investment standpoint, since everybody's generally overweight to domestic equity markets in their portfolio. That was the worst performing part. Large caps did a little bit better than small caps during this period of time, which you would expect. Small caps definitely more sensitive to economic slowdowns and things like that. I think a lot of these kind of trends, and you see one of the things I highlighted in here was, from my reference, was really this 50 basis point policy rate cut by year end. That's actually one thing that's been consistent from this period to today. Is I think that's still sort of the expectation, is that we'll have rate cuts this year. I think that's very data dependent, and certainly subject to change, but that's what the market is pricing in as of yesterday, is 2 25 basis point rate cuts before the end of the year. If you, let me see, so growth value, in terms of, I think one of the things we're going to talk about is the international markets coming up, so I'll skip through some of that kind of stuff. So on the bond side, on page 9 or page 25, if you're looking at the PDF, you can see what kind of happened in the fixed income market. So as people take money out of stocks, they look for other things to invest in. Bonds were the beneficiary of that. I think some people during this period of time where we had some concerns about the economy and people were sort of predicting rate cuts. Rate cuts benefit bonds because as rates go down, prices go up. And so you see some people putting money into bonds, not just for the flight to quality, but because there's perceived appreciation in the future if we start to see changes in interest rates. So treasuries did well, up almost 3% during the period of time. High yield's really the worst performing sector. I think that's something you would expect. High yields generally trade more with stocks than with bonds. And so even though that is true, and we did see this flight to quality, high yield bonds were positive during the period. I think that's largely because of the yield component to owning those being a little bit higher. So what does that mean for the overall portfolio? Page 12 or page 28? I'm guessing now we're getting into some bigger numbers. So, so what did that mean for the overall portfolio? You can see the very top, December 31, we had about 25.5 million. As of March 31, we had about 25 million. So we lost about 500,000 during that period of time. If you flip over 2 more pages to page 15 or 31, it wasn't all depreciation during that period. You can see if you look at that total fund line there at the bottom during the quarter, contributions of about 71,000, distributions of about 266, income of 133, and then depreciation of basically 350,000 during the period. Largely, that's in the places that you would expect: Vanguard, S&P 500, MFS Growth Mutual Fund. Now, if you jump over to page 17 or 33, I'm gonna miss one of these. You can see how the overall portfolio performs. So for the quarter, we're down 85 basis points. The benchmark was down 86, so that's right in line. Relative to peers, that's a little bit worse, the 85th percentile. You guys are familiar with what the little numbers in the brackets mean, right? So there's two ways that we look at performance for the overall plan and then for the individual strategies. We look at it relative to the benchmark. We also look at it relative to the peer group, and that's going to be important when we start talking about some of these different asset classes, because it takes both of those together to kind of get a sense for what really happens. Sometimes the benchmark's really easy to beat, sometimes it's really hard, and so we look at how other managers did during that period of time. The quarterly performance is largely because we're a little bit heavier on the equity side than most plans, and equities didn't do as well. So that's really where that 85th percentile comes in, and I think something that you've seen maybe for the last year or so in the overall portfolio. From an individual composite standpoint, total equities, that's all the equities in the portfolio, slightly better than the benchmark, down 219 versus negative 2.45. The domestic equity component solely down 339. Benchmark was down actually 472. So domestic equities did better in this market than most did. Obviously the index fund is in line. MFS Growth was down almost 9%, but its benchmark was actually down almost 10, so that's about 1% better. Median was down a little bit more than 9%. Dodge and Cox Stockton, that's a value-oriented fund, up 345. Benchmark was up 214, so better performance there. And then Eaton Vance, the Atlantic Capital SMID Cap product, down 461. Benchmark was down 750. That's a bigger fund, tends to skew a little bit higher in the capitalization spectrum, and so that kind of makes sense when you think about how small caps did relative to the rest of the equity sector. If you flip over one more page, the international side, and then we're going to spend some time on this. We have one manager in the international space, American Funds Europe Pacific Growth, up 262. Benchmark was up 536. So really trailed benchmark pretty substantially during that period of time. There's a few reasons for that. Specifically, big position in Novo Nordisk. This is back in the time when we spent a lot of time talking about tariffs, and that was a big issue for them. They also had a drug trial that didn't go exactly as people had hoped it was going to go, and so that hurt them. But relative to the benchmark, and this is something that we've seen, you want to talk about the international place, everybody does. That's kind of been the trend, and the reason is sort of international equities is the new large cap growth space, right? Where nobody beats the benchmark, everybody does poorly. The market has narrowed pretty substantially, meaning that it's driven by a small number of names in the portfolio. And so when you look at performance for Europe Pacific, you can see 43rd percentile, so they're better than the average manager in the space. Benchmark's in the 16th percentile. If you go out to the 12 months, it's in the 14th percentile. 5 years, it's in the 15th percentile. So active managers aren't really doing well in international equity. And it's really the same kind of factors that have impacted the large cap domestic equity space over the last, it's been a long time, 10, 15 years or more. They've had some stock selection issues, obviously. This is a very big fund in the sense that it's very diversified. It's got like 350 names, runs about 12 different portfolio managers that each manage a sleeve of the portfolio. This is not the kind of market that they're going to do well in. One of the reasons that we like it, it's very inexpensive relative to a lot of other funds in the space. It also has the potential to have a pretty substantial position in emerging markets at a very reasonable fee. Emerging market investing is very expensive. It's also a little hard to deal with in short periods of time when you're doing it in a dedicated fund, volatility is pretty high, and it gets masked a little bit when you use a fund like this. So there's definitely some benefits to it, but it's struggled with the same kind of issues that a lot of other funds in this space have, which is just the inability to really concentrate the portfolio and capture what's working and stay out of what's not. If you go down to the domestic equity piece, so you've got one manager here, Baird Core Plus, so they were up 260, benchmark was up 278. What really hurt them was the plus part of the portfolio. Core did very well. Asset-backed securities, mortgage-backed securities, foreign debt in the portfolio was really hurt them. Lower quality names relative to what's traditionally core. But overall, still a really close to being in line in fiscal year to date, doing well. In the more alternative section, you have two managers. You have the Brookfield Infrastructure Fund, and you have Intercontinental Real Estate. So Brookfield's done very well. Some of this is beneficial because of the fact that infrastructure is really more of a global asset class, and that's helped more recently. Real estate has been more of a challenge. It's been a challenge for everybody. Everybody wants to talk about real estate. Everyone wants to talk about international equity. Real estate has been a mess really since COVID, maybe a little bit before. But the biggest issues the real estate's dealing with right now is really just the lack of transactions. Nobody wants to buy or sell anything in the office space in particular. So if you had a lot of office when you're going in, you still have a lot of office, which is still kind of a problem. And when you look at office in general, that was 45-ish% of the benchmark, probably the mid, 2015 range. That was the biggest section of core real estate. Nobody wants it, and you can't do anything with it. I think I saw a study, and don't hold me to these numbers, but when you look at these office buildings that are out there, people own them, try to figure out what to do with them. Nobody needs office space anymore, so what can you turn them into? It's like 10% of them that you can realistically, cost-effectively turn into something else. So you have these buildings that, there's one in St. Louis sold for like the largest building in the city of St. Louis sold for like $5 million.
That's crazy. I saw that.
Yeah, it's crazy. So it's going to take a second to kind of work through some of that. Intercontinental also has a little bit higher leverage than core, and that's hurt as well. So you're still getting the coupon, but overall up 69 basis points for the period, so that's positive. But trailing the benchmark, and I think it's likely going to be more of the same in the short run for this fund. So move on to the next report. You guys got questions about this one?
About Intercontinental?
Well, I thought we can
Come back.
talk about whenever you want. I was kind of
Just
trying
go
to
through
go
the
in
report.
order
Yeah,
on the
that's
agenda,
good.
but you can handle it however you want to deal with it.
Perfect.
The next one is the short book. I don't know, you tell me what pages these are. The May 31 flash report.
Flash report means, that one, is not on the tablets. Do you want to take a look at that?
Yes,
Yeah,
you all have
everybody's got
paper,
that.
so you don't have a tablet for this. So it's thin books, very short. There's really not a lot in this other than just an update as kind of where you are. So we were around about 25 million. Into May, we're about 25.8. So April hits, everything's better. Everybody's happy, large cap's doing well. Everything's kind of the opposite of what it was in the first quarter. So this doesn't do a 2-month number, it does a 1-month number, but for the month of May, overall portfolio is up 384, which is ahead of its benchmark slightly. Domestic equity up 591. Dodge & Cox still doing well during this period of time, up 381 versus 350. So still getting some benefit out of the value stocks, but the growth side, MFF growth up almost 9%, largely in line with its benchmark. S&P was up a little bit less than that, 6.25. And then smaller companies, Eaton Vance, the Atlanta Capitals been kept 297. So what benefited them during the first quarter, which is having a little bit larger market cap, hurts them a little bit during this quarter as smaller caps do better. benchmarks of 599. Euro Pacific does better, 589 versus 469, so better than peers, better than the benchmark during this period or for this month. Fixed income on the next page, page 2, Baird Core Plus down 45 basis points, benchmark down 472. So everything that everybody that put money into fixed income to keep it out of the equity markets undoes that to a certain extent during this period of time, and we see sort of a flight back to risky assets. So bonds do poorly relative to the rest of the market. We don't have pricing for Brookfield or Intercontinental intra-quarter, so you have zeros there. So things are potentially a little better than this shows because this is a monthly flash report. Now, the one thing that we'll talk about in a little bit, but I think is important on page 3, a little bit light on the fixed income side, a little bit heavy on the cash side in the portfolio. So we have some things to talk about with relation to that, but I wanted to bring that up and kind of show you graphically what that was. Questions about the monthly report?
Anybody?
Okay. All right. So, updating letter, standing letter for cash management. So, reached out to Salem Trust and asked for information regarding the ability to raise cash and invest cash intra-quarter. Investing cash, I don't think is a huge deal. Raising cash can be a huge deal. If we have unexpected expenses and we need to make benefit payments, we need to have a mechanism to be able to do that. So what they sent me, I was a little bit surprised by, a letter that I drafted in 2014. So that was, so when she sent me this, I asked her to verify that the amounts that they were using as necessary amounts to make benefit payments were accurate, and they are not. So I drafted a letter for you that is included in the information that I handed you there. This isn't necessarily to do this. You don't have to have a standing letter. What you do need to do is have a mechanism to be able to raise cash if needed. So we can try to take care of it, and I think it's a prudent practice to try to do it at meetings, but there's something that needs to happen in between meetings. We need to have ability to do it. If you don't have a standing letter like this, you might have to have a board meeting. In between meetings, to be able to get that done, that requires at the very least an agenda and notice and some things like that to be able to get in there to do it. So most people have some kind of an alternative plan in place to be able to do it if it's necessary. And so I drafted this up. This is a little bit more simple than the letter that that currently have on file with Salem Trust. It changes the target balance amount to $300,000 from $50,000. And that's just because of the way that the plan works now. She said that I think 50,000 was pretty lean back in 2014, but I think the cost structure of the plan is different now. And so 300,000 is the custodian's recommended target balance for the plan. Way back in 2014, we did it a little bit differently, where we were talking about contributions, distributions, and things like this. This letter basically just gives the custodian the ability to add money or take money from what I used was the core bond fund in the portfolio, the core plus bond fund in the portfolio. It's the most stable asset that you have. It can be any asset that you want. It can be an asset that we don't have in the portfolio today if you want to put a different one in to use for the purposes of raising cash or investing cash. I think that's fine. You can take out the part about investing cash, and we can take care of that when we meet, but I think we need to have the ability to have Salem raise cash if we need them to. So this is a draft. We can mark it up however we want to, but my recommendation is they have something on file to be able to at least raise cash if you need to, because making benefit payments is pretty important. I don't know how easy it is for you guys to get together into a meeting.
Now, is it unheard of if you have to do this to have somebody sign off on it? I get, instead of having all of us have to meet, but like one of us or
So you can.
any of us have to, and almost any bill we have to approve anyway.
Yeah, so do,
if we're taking X amount of dollars that we don't even know how much, you know, like it went
Yeah.
below the floor, now we're taking who knows how much out. I would think that you guys would like to, I always say, you guys, this is your guys' ball court, not mine as much.
do you
So
have a signing authority?
I would think
I do.
that, you know, you guys would want to know, hey, what's going on?
I would think we all would.
Yeah.
Some boards will do a situation where you have trustees that have the ability to sign, you have an administrator that has the ability to sign. So you have one, the administrator and a trustee.
Yep.
We can have Salem reach out to us when we need cash. We can tell you what it is that we think you should take from the portfolio. And then we can do a letter.
Yeah. I would like to know your guys' thought. That's mine. I would like, I think
We can
should
absolutely
know.
do that.
Or I think they should, not just one company reach it in the pocket.
Yep.
Well, it would only be to pay things that we would have, I'm assuming this, ordinary things that we would pay anyway, but sometimes they just come up in an order that we could run out of cash. Is that what you're?
Yeah, this is not, I mean, this is, the letter that's on file is kind of, it's been there for a long time. This doesn't come up very often. It's just one of those things that I think is a kind of a safety net for you. So having the ability to reach out and having somebody be able to execute a transaction inter-quarter, you can ratify it at the next meeting. If that's what you want to do. That's certainly something that's doable as well.
So, and if I may, in your packets, and I don't know if you have a printout in front of you, but page 68 of 119 is the proposed updated letter. And it's got 2 authorized signatures on that letter. So I guess my question is, would that letter be what stands and 2 signatures are not needed for these cash raises, or will there be, at the time of a cash raise, another letter like this, and Joe and I, because Joe's the primary signer via DocuSign, and then I add mine a second. Would it be a letter each time to keep the board informed of the cash raises? Okay.
Yeah, I think what we would do is, if you wanted to go that route, don't sign this letter. We'd get rid of this letter. And then
I see.
we would have a specific letter each time this would occur. It might say raise $300,000 from the Baird Core Plus Bond Fund, but we'd send it over. Chrissy would get with you guys would do the signature, send it to Salem would raise the money.
Well, then we should agree to authorize somebody, Joe, whoever that is, to be a signer of that, or else we're going to have to get back together again to approve doing that. We would have to do that today, if you will.
Right.
And I believe anybody who's on the Salem Trust authorized signatures form, which I'm pulling up right now,
I think that's who it would be.
is authorized to sign. And Joe's the one who we send all the invoice or the warrants to sign via DocuSign, so I guess he would be primary, but there's a few of you that can sign. Hold on, having some server issues. So I guess, okay, so it's either or, either a standing letter or a letter each time cash is required.
Yeah. When we did this originally, a long time ago, this board did not have a lot of administrative support. Right, you had a firefighter that was acting as a secretary that was really handling a lot of the administration in addition to his job as a firefighter. And so things didn't happen between meetings very easily. And so it's not necessarily to have something like this. You just need to have an idea of how you want to handle it should it come up.
I had a quick question. I don't mean to sidetrack either, but instead of having a concrete amount of cash to hold, why don't we have an allocation to cash in our overall investments? Or do we?
Yeah.
Good, yeah.
That hasn't been something that this board has normally done. It is something that you're seeing more. The reason it wasn't done historically is because cash didn't pay anything. It's a reasonable place to put money now, because you do get some yield off of that. And so we can have an allocation to cash, 2 or 3%.
That's usually the norm.
Just thinking that it makes it a little bit, increase the flexibility so that we, whenever the accounts rebalanced or whatever, we have the cash on hand.
I think we have the attorneys on the
Paul,
phone.
I got you. I'm holding
Oh,
my
sorry,
phone
Paul.
right in front of the board.
I just want, it's excellent, all good. I did hear a comment about putting it on the agenda, putting the transfers on the agenda for ratification after they're made. That's kind of a good idea, and if you do that, you can put it on the consent agenda so that, members can see it. If they've got a question, they can pull it from the consent agenda if they want further discussion. So I just wanted to mention that.
Yeah, that's a good idea.
That's a good point as well, because even if Joe and I sign, then the four of you aren't aware of what's going on. So we could certainly do that. That's a great idea. Maybe Paul, maybe I'll keep him, I'm afraid of feedback. What if I put it here?
We'll try.
Put it actually in front of the
That'll probably
microphone.
be the last.
That way it'll come into the recording. I'm not gonna be able to hear his statements on the recording unless it's going through the mic.
Well, Paul basically just said, he said that, that we'll probably conclude his comments, although, Paul, stay on the line because I am gonna ask the board once we get to my report whether, they would like to be billed for your services monthly or quarterly or annually. So, stay on the line. I'm gonna keep you by the microphone, and I'll get up and move you as needed.
So Garrett, go back to your cash allocation, so then if we had that, we wouldn't need to do this.
Theoretically.
Theoretically,
If-
yeah.
If we had, as long as we're diligent about rebalancing the portfolio, I think that's true. A 2% allocation is 500,000, so that gives us plenty of cushion in there.
And that could be adjusted too. We don't have to have that.
For sure.
Have to have 500,000, right?
Yeah.
We can have some other number, 200,000, and at the end of each quarter, you could say, well, you know what, we spent 100,000 of that, we need to put 100, or you just do it automatically, just,
Yeah, we can do
that
that.
makes sense.
So
This
I'll
is your-
I'm not trying to substitute my judgment here for our investment managers either. It's, and what makes the most sense for administration and investment policy and rebalancing the accounts and that kind of stuff. I want to defer to you guys on that as well.
It isn't really for me. We do it a lot of different ways with a lot of different plans. It's really what works for you guys. We are starting to see plans use a cash allocation in portfolios now. I think that makes some sense to have in there, and then just diligently rebalance. It used to be that we'd have plans that didn't have a quorum, couldn't have a meeting, whatever happened, and there would be more than 3 months between meetings when things would, before people would get back together. That's when you sort of run into some of those kind of issues. I don't think that's probably a big issue here.
No.
But that's, back in the old days, when you didn't have a lot of administration and you didn't have a lot of help, and it's not as always as easy to get trustees in every place as it is in some. So maybe you only had 4, and there was a long period of time when, I don't know which board, one of these boards only had 4 members for a while. So a couple people don't show up and you have an issue. So what I will do is I'll redo your IPS and I'll put that allocation in there, and I'll bring it back to you guys at the next meeting so that you can kind of see what that looks like. We have plenty of cash today, so it's not really a huge issue. And it sounds like you guys are okay with letting the custodian reach out when we don't have enough cash.
Yeah.
And we'll go ahead and get a letter over to you guys if that ever comes up, or certainly comes up in the meantime.
Everybody good with that?
So just to put a fine point on it, then we're going to have the ability for the custodian to reach out and raise cash as needed by basically a consent warrant from the board afterwards.
Yeah, so
Go ahead, sorry.
it'll basically be the same function as when we make a change to the portfolio. There'll be a letter of direction that goes from the board to the custodian directing them to make a transaction. So it'll basically be the same as that. There won't be any standing instructions. It'll just happen sort of an ad hoc basis.
But those things happened because we decided at a meeting,
Yeah,
and then, so the decision was voted on and made. We're kind of doing the opposite with this.
this would be a situation where you'd have to ratify that decision after the fact.
After the fact, yeah.
And it would not be a rebalance or an investment decision. It's basically just we have to raise cash. And you can figure out where to raise it. You can ask us where to raise it. We're happy to give you our thoughts on that. And generally we're gonna take it from wherever you're overweight in the portfolio. But that's how that would work from a functional standpoint. And then we'd largely, I mean, you don't have anything in here that's not super liquid other than the two private investments. Everything else is mutual funds, so we'd have cash pretty quickly.
Well, I mean, I know it'll change, but cash allocation now, I mean, cash investments are paying, I get 4%. I mean,
Yeah.
so why would we not do that?
No,
In
it
some
makes
cases,
sense.
that might be better than some of our investments. I
It
mean,
makes
now
sense.
that's gonna change, I know.
Yeah.
But,
Long-term, it's
and
the
I
worst
don't mean-
performing. Long-term, it tends to be the worst performing asset, cash.
Yeah.
But so when you talk about being diligent in our rebalancing, does rebalancing require a vote of the board?
It would.
It
Yeah.
does, okay.
How that would work is we would come in, we'd make a recommendation to make changes to the portfolio at a meeting, vote on it, we'd get that executed, we'd draft a letter, send it over to Chrissy, she'd send it to you guys, everybody would sign, and send it to Salem Trust to be executed.
So I like the way this is coming together. So we have an allocation to cash that they can draw upon as needed. Now, when we get to running out of cash or if some expenses come up, they can get to it as needed, and then we ratify that after the fact. And then we come back and say, okay, we're real low on cash this quarter. In our next meeting, rebalance, add more cash to the portfolio, and take away from places you're overweight. I think that makes a lot of sense.
me too. Me too.
Okay.
You guys good with that?
All right. Well, I actually
sure.
have a recommendation with regards to the cash position now. It's about 800,000. So if we're looking at, say, a 2% allocation, that's 500,000. So I think we need to make a contribution to the Baird Core bond portfolio of 300,000. Just take that cash level down to sort of that future target level.
So moved.
Second.
Anything on the question? All those in favor signify by saying aye.
Aye.
Opposed? Motion carried unanimously.
Okay,
Thank you both.
we'll get that started. Okay, so my last two things deal with investment managers. You have a preference here on the order? I got so much paper here, it's ridiculous.
No, do whichever one you want.
Okay, Intercontinental's been in here for the longest, maybe not, I don't know, but Intercontinental's been here for a long time. That was the one, Bill, you asked about first. So Intercontinental is a private investment. So we have limited liquidity, quarterly liquidity, best case. It's less than quarterly today. There's about $11 billion that wants out. It's roughly 20% of the fund. This is not an unprecedented period of time. This happened in 2010, 2011. What happened for the most part during those period of time is people didn't get their money. They rescinded their orders. Now, we've had conversations with Intercontinental recently. They're looking at some ways to raise some of that cash. So they've got some buildings that they think are gonna go under contract. They've also got some lines of credit they can tap to pay some people out. Now, the way their queue works is everybody in front of us would have to get 100% of their money before we get any. So it's unlikely that we would, even if we went into the queue today, it's unlikely that we would see money for a year. So from a liquidity standpoint, there's very little. Now, I do think there's opportunity in this space in the future. I think that there's a lot of uncertainty today as the real estate market kind of reshapes itself. And so I wouldn't really do anything with this, would be my recommendation. I think there'll be better opportunities in the future. Now, there are secondary opportunities to be able to sell some of these kind of positions. It's generally not attractive to do so. You're taking, I'd have to get a quote on this, but half, maybe, for your position, maybe less. So it kind of, you're kind of in and I think there's a lot of bad news that's been priced in. I think there's probably going to continue to be some additional pain, maybe, or underperformance relative to the market as we go forward in the short run. But I think longer term, you had this manager for a long time, and since you put him in the portfolio, you know, we went through 10 years of double-digit return, and we really got most of that. And so when you go all the way back to 2011, even with the performance that you've got today, you've averaged 8.62. So
Not too shabby.
that's a pretty good number. It's also ahead of the benchmark. It's in the 30th percentile. 10-year numbers actually a little better from a percentile ranking. The numbers are a little bit lower, 6.42, but 23rd percentile. So it's done well for you. The problem with these illiquid investments is you just don't have the ability to trade in and out. You kind of get in, you got to pick somebody you like because you're kind of married to them, and nobody wants out when things are going well and they don't have keys to get out, and then when everybody wants out, then that's kind of an issue. So you're still getting income. I think it's about 4% a year, so 1% a quarter. When we originally went into real estate, that was really the source, what we were looking for. We're getting nothing out of bonds, we were getting nothing out of cash. All we had was equities, and we were looking for a way to sort of give us some income and give us some of the stability that comes along with having a reasonable level of income. And I think we got that, and I think we'll still get some of that in the future. I do think there's still going to be some appreciation issues in the short run. So that would be.
Looking at YouTube for thoughts here.
There's not much we can do, so.
Yeah, we can't sell now. We're not only we're not allowed to, but we're selling at the bottom of the market, or
Yeah.
maybe at the bottom market, close to it anyway. It's closer than we were a couple of years ago anyway. This is, like you said, we're kind of married to this investment manager for the time being, unless we want to sell to the vultures, and we don't want to sell to the vultures.
No, definitely not.
So that's my recommendation. It's probably not popular, but I think I still think Intercontinental's done. I don't have anybody that's really ever been upset with them. They've done a good job. They're a little higher leverage. When we got into this, they were really more of a core plus kind of fund. They've really come down to be more of a core type of an investment. So I think they're less risky today than they were before. Probably don't have as much geographic diversification as some funds, although I don't think it's a concentrated fund by any stretch. And I think they've done a good job. So I'd stay put. I'm not trying to paint a rosy picture and tell you things are going to be great in the next couple of years, but I think all said and done, I think you're going to be happy you had them long term.
Well, thank you. I think we needed to hear that.
Yeah.
Well,
Anytime I'll keep you guys updated on kind of what happens with them. We do meet with them. We have a lot of exposure to this company, so we do have a lot of communication with them. We can absolutely have them come in here and tell you. I mean, I think I can sort of parrot what they say and what our analysts say. Sometimes maybe you need to hear it from them, and we can certainly do that if that's something that you have an interest in. I generally don't bring them in because I don't know how much value there really is in some of that. But when you get into some of these kind of investments, they can talk property-specific stuff that is more difficult for me to do.
yeah. I don't know if that would really help us, but.
You don't have to make a decision now. That you decide later you want to do that, just let me know.
Okay.
Okay, so the next one was Europe Pacific Growth. So it's got growth in the name. We don't really think it's very growthy. It's really much more of a core fund. It's very, very large. Very, very large. A lot of names. Probably skews a little bit more towards the growth side than it does value, but still a very core holding. Very cheap, 49 basis points. Market's probably 80 to 100. For the developed exposure, maybe 100 to maybe 120 for the emerging market exposure, so it's very cheap exposure. One of the things that, you know, we kind of talked about when we went through this initially was really the narrowness of the market. That has hurt a lot of managers. It's going to hurt this fund more than average just because of the number of names it has in the portfolio. Still, when you go back and you sort of look at the performance, you've got your, for the quarter, this is in the quarterly book, not the flash, but you know, down 274 to the benchmark for the quarter, down 205 fiscal year, down 631 for the 1 year period, 175 for 3 and 153 for 5. Those numbers sound terrible. Right? That's not, those aren't what you're looking for. When you look at the peer group rankings, so we got a manager, we pick them, we want them to beat the benchmark, that's the expectation, right? And we say 3 to 5 years is a fair measurement period. If they're not beating the benchmark, then we're going to get rid of them or look for somebody else. Well, they're certainly checking that box, right? They're behind the benchmark for 3 years and behind for 5 years, and pretty substantially. So when you look at what else is available, what are our chances that we're going to pick a manager that can do better than them? Well, they're in the, for the 3 year period, they're in the 45th percentile. For the 5 year period, they're in the 35th. Top half of the peer group. It's not very good that we can find a manager that's going to do materially better than this that's active. Now, one of the things that we can do in the space is we can go passive for a portion of this. We can go passive for all of it if that's what you want to do. But we can go passive for a portion of this. So when we put managers in the portfolio, we're looking for 2 things. First is beta exposure. That's the market, right? That's what gives us roughly 90% of our return, stocks versus bonds. The second component of that is alpha. That's the manager's contribution in addition to beta, right? Their outperformance relative to the market. That's a much smaller component of our overall return. We pay a management fee for the hopes that we're going to get that additional return, that alpha return. We certainly haven't got that here. And so one of the things that, and normally historically what you would say is, well, there's parts of the market that it's easier to pick stocks and there's parts that are harder, right? Large cap domestic equity, very difficult for managers to outperform and outperform materially, even if they do. International was always an area where you thought, well, there's a lot less information that's available. There's a lot greater chance that the companies that spend the time looking for stocks internationally, they have a really big pool, they ought to be able to outperform. And they ought to be able to outperform materially. That's changed a little bit. And we're seeing that with the benchmark in the 23rd and 15th percentile for 3 and 5 years. Finding a manager that's ahead of the benchmark for a 5 year period, there's 15% better. It's not 15 managers. Those managers all change. It's the benchmark that kind of sits in there. So the managers that fall into that top 15% move. So it's very difficult to find somebody that's done better than this. So I have a lot of confidence in Euro Pacific Growth. Had this fund for a long time. I think it's got a lot of advantages relative to the market. This is not the best market for them. They've also made their share of mistakes, right? They've had some concentration in the portfolio with Novo Nordisk. They've made some stock selection issues. They've made some sector selection issues. And I think one of the things internationally, when you look at, you know, they were underweight China. China's done better, and they didn't have enough. And so part of it's on them, part of it's the market. It's kind of a double headwind sort of a situation for them in the short run. But it doesn't give me a lot of heartburn for them for you to stay right here. It also doesn't give me any heartburn at all to have you take half of this and put it into, you know, Vanguard Total International Stock Index and get yourself closer to the market. You still have a chance to outperform, but you're sort of having that chance for the safety of knowing that you're only going to go down half as much relative to the market because you've got that passive exposure.
What about more of a Vanguard-specific Europe? Because there's a lot of investment in Europe now these days with Germany's new government, France's.
So I didn't do any research on that, so we can do that, if that's what you want to do. I think that brings us a little bit more into the actively managing that space than passively managing it. So, I could look into that, but if you've got something in mind, I think that's certainly something that we can consider. But generally speaking, when we go passive, we look to be the market rather than some sectors of the market. We don't do a lot of this sector.
Like personally, I have like the Vanguard European index, which is it's passive and it's done very well here recently.
Yeah, I could look into that. I couldn't speak to it at this very second because I don't know what the prospects of that are versus what you're leaving out.
Sure. Is there, when we communicated back and forth, I thought you indicated there was a Euro-Pacific growth passive fund or something similar to this, that we could look at and look at comparative results for the last 10 years in the same format.
Yeah, so you could look at basically Vanguard total international stock index. It's basically going to be the benchmark that you kind of see there, right? So if you're looking at the book, there's the Euro-Pacific line at the top, and then the line under that's the benchmark. That's essentially what we would be buying, is that benchmark minus a very nominal amount of fees. So that's what it would look like. And we would track it in here the same way that we track, we have the Vanguard Index 500 in the portfolio. We put it in there, if we buy that fund, we put it in there as a manager, and then we still track it against the benchmark. So we have that passive exposure in the domestic side. We could absolutely do that in the same way.
Nope. As he pointed out, the benchmark is pretty tough to beat in this space now. And 10 years ago, maybe not, but now the benchmark is very tough to beat, and it's very inexpensive. And usually when I look at this, I'm trying to hedge and cover risk, and my answer is I want to do both. So same thing you guys have done with domestic equity, and the allocation is to have an allocation in active. You got your growth funds, you've got value funds that they're going and picking stocks and trying to get that alpha, outperform the benchmark. I think it's probably time to look at doing some of that international space as well, whether it's with the total international index or with the ex-US or something like that. And I don't have a huge preference on any of that, but it does seem like the benchmark, with how efficient that market has gotten, would be something that we would want to consider seriously.
I'm good with or a portion of it,
yeah.
We don't have to do it all.
Yeah, agreed.
Yeah,
and I'm not
absolutely.
suggesting to do it all.
Because historically, that American Funds Group, Euro-Pacific is a
They're
incredible
really
fund
good. Yeah.
long term. I mean, it's a rock star out there.
It is.
It's just the last couple of years it's not been so rock
They
star-ish.
had a really bad year there. Yeah, I would generally do half. That's kind of where I go with stuff like this, but there's no magic to that.
Right.
I wouldn't do 100%. That's just me. I do think there's some opportunities in this space longer term. I don't think that's true about every space, but I think international, I do think there's managers out there that you can expect to beat the benchmark long term. So that would be my recommendation, is that we take half of it and we do the Vanguard Total International Index. Now you can table that and we can talk about the sort of country exposure and things like that if you want to come back to the next meeting. I don't think there's anything that's going to happen between now and then that's going to make this something that we need to do today. So if that's something that you would like, let me know, and I can come back and kind of talk about what else is available out there. I just am not as familiar with some of the subsectors of the total international.
I think that's a good idea. In the next meeting, come back with
any other funds that either of you, passive funds that you might work with or think about, or we should look at?
I mean, he said the European one. I guess the only difference between that and the ex-US is like the Japan and China exposure. So I don't know. we have 3 different benchmarks, I think, in there, 2 or 3 different benchmarks. I would guess, see a fund that represents each of them. There's the IFA and there's the XUS, and I don't know, the European one.
The European,
Makes sense.
yeah.
Yeah.
Thank you.
I know you guys are good with that.
No point in looking over here.
What are you talking about, Joe?
You're not considering Asia, you wouldn't consider Asia by itself, would you? I won't bring that back if you're not.
I would probably err on the side of broader exposure at that point.
I agree with that completely. I just don't want to exclude something that you
But,
just wrote
and we're going to defer, you're the investment manager, so I'm going to defer to you on that.
Yep, okay. All right, I'll do that. Thanks, man.
Yep, that'd be
So-
great.
Let's see, did we cover everything with you, Jack? I guess so. Any questions for Jack?
Thank you,
Yes,
guys.
thank you.
Thank you very much.
Chrissy?
Yes, sir. Okay, so the first item is the renewal of your fiduciary liability insurance policy. Very exciting stuff if you want to see it. This is on page 74 of 119 in your packet. Oh, thank you. You guys have a 3-year policy, which I think is great because, generally my clients that have 1-year policies, the premiums increase every year. For you to renew your 3-year policy, the annual premium would be $3,250.18, which would be the same for all 3 years of the policy term. Bill did ask me to look at some other clients with comparable asset size to see if that rate is appropriate. And so I just pulled some clients for comparative purposes. The police plan, Punta Gorda Police, they have a very similar market value of assets, approximately $28 million. They also have a 3-year policy, and their annual premium is about $4,400 a year, which is interesting. I'm not sure why. They may have had a prior claim or something to that effect, that it makes it a little more expensive. I'm not sure. I need to dive deep into that. Edgewater Fire, their market value of assets about $25 million. They have a 3-year policy also and are paying about $2,800 a year. North River Fire is about $35 million in assets. They have a 3-year policy and are paying about $4,200 a year. And then I pulled another one a little low, but St. Pete Beach Fire, approximately $21 million in assets. A 1-year policy, they're paying about $3,300. So it definitely varies. It varies on the carrier. It varies on the market value of assets, if there have been ever any other claims filed in the past. But yours is very appropriate. In fact, it's kind of floated around that same premium for the last several years. So it seems to be a really good relationship you have with this broker and this policy. The policy expires June 30th, so I do recommend that you bind coverage, but certainly if you'd like me to go out and look around and see if I can get a lower premium for you, I can. I've definitely had carriers tell me, hey, this is the best they're going to get. I can't show you anything else, but I can certainly ask. So we'll need a motion to bind the coverage, and if you'd like to direct me to look for additional quotes, I'm happy to do that. If you're happy with what you have for this 3-year period, then even better.
And I asked Chrissy that I didn't want to reinvent this again. We went through this a few years ago about this fiduciary insurance. It just seems like it was so expensive, but it sounds like we're pretty close to the average or.
Yeah, I think we're, based on all the other plans, I mean, it sounds appropriate, and
Sounds like
she
we're-
can hunt, and we save $100 a year or 200, I don't know.
I don't know, I think we should make her earn it.
Yeah.
All right. Coming back with a fee increase. I'm just kidding. Just kidding. No, truly, I'm happy to do it if you want me to see if there's something better, and there may not be.
I'm okay either way.
Yeah.
So is there a motion to at least bind the policy?
So moved.
Motion and a second. All those in favor signify by saying aye.
Aye.
Motion carried unanimously.
You want me to look around and just see? Doesn't hurt to ask.
If you're willing to
Yeah,
take a
you-
quick look, sure.
Yeah,
Of
why
course.
not?
Yeah.
I am willing to do that, absolutely. I don't think we need a motion for that. I'm just going to reach out and see what I can do. Just add that to the minutes really quick. Sounds like I'm typing really fast, but it's not pretty, I promise. Okay, so the next item is your financial disclosure forms. As of last night when I checked, Garrett, you're the only one who still needs to file, so I can send you the link to the electronic financial disclosure management system. All the information that you've already populated, I believe it should just appear again, so you just have to go through it and then submit. And of course,
Okay,
if there are any
yeah,
changes,
I probably
you'll
just missed the email.
That's okay. You have until July 1st, and actually September 1st is when the fines start to accrue, so there's a grace period, but
I'll get it done.
July 1. I know you will. And then I guess before I move on to the educational opportunities, if you recall the fee structure for Paul's Legal Services, you elected the $500 per month retainer. I guess the question is, and maybe this is more for me and my people, but do you want to see monthly invoices, quarterly? Do you want to do one annual invoice? Do you have a preference?
I don't think you'd want to do an annual invoice.
Yeah, I mean, monthly or quarterly. That was just, it was on the table, but.
Transparent to us, ask him how he wants to do it, quarterly, monthly, whatever.
Paul?
Well, our whole architecture in our system is set up monthly if possible, but in terms of the invoices the board sees, my suggestion would be just to add them into the monthly invoices. If that's okay, I'd add them into the consent agenda on the items that they then ratify, if that's how you want to do it. It's already been approved. This will be the regular, that's how I would do it. I would commonly what I have my boards do is just put it in the stuff they ratify, right? Aren't there regular bills? I'm learning here with you guys. So aren't there like regular bills you'll get that come through, and then the quarterly meeting comes, you've got a listing of them, and the board can look through them and make sure they look good. And if not, they can pull one, or if they have a question about one, they can pull it and ask it. Otherwise, it's approved on the consent agenda.
Yeah, so.
Does that make sense?
Yeah, so how we do it, Paul, is as the invoices come in, we generally do one warrant at the end of each month. This quarter seemed a little light. But normally it's 3 warrants on an agenda with invoices that have been paid. And when those warrants go to Salem Trust, there are 2 authorized signers required. So generally, after my office does a review of the invoices against the contracts, et cetera, we send it to Joe Lindsay via DocuSign to be the second signer. So we get 2 authorized signatures to pay the warrant. And then at the meeting is when the Board of Trustees ratifies those payments. So we can certainly do that with your monthly invoices. And you'll see those on the consent agenda.
I think that would be, if I could wave a magic wand, that would be the easiest thing for us to work with. Thank you.
You got it. And then the only other thing I had is your educational opportunities, which I don't have anybody going to the FPPTA annual conference, right? Yeah, like in a week. But I think Joe and Danny, you guys were going to go to the October one, and that's still a go. Anyone else planning to go to the fall school for FPPTA? That one's in October. It's a hike. It's up in Sawgrass and Ponte Vedra. And then I did find another education opportunity with an organization called NCPERS, the National Conference on Public Employee Retirement Plans. They have a conference in Fort Lauderdale in October from the 26th through the 29th. It's the Financial, Actuarial, Legislative, and Legal, or FALL conference. It will be taking place at a brand new Omni Hotel in Fort Lauderdale. It's not even open yet, so if you want to trip and learn some really fun financial, actuarial, legislative, and legal stuff, just let me know. The registration cost for NCPERS is only $315 for a membership, so if you want to go, I'll ask you again in September, just something to keep in mind. And that concludes all of my prepared remarks today.
Thank you, Chrissy.
You're welcome.
We have anything under old business? I don't believe we do. Trustee comments? Anybody? Excuse me. Nope. Anybody in the audience have anything to say? If not, then we will stand adjourned. Thank you.